Now that you know the rules for the wave principle that we went over yesterday, we're going to learn how to apply that today. And welcome to the second day of the Elliott Wave Intensive Weekend Workshop. I'm going to give you some pointers on what to keep in mind, what parts of the wave principle, what aspects of the wave principle to keep in mind to get you through these real-time trades. First of all, I'd like to, most of you have probably seen the first page of the section, which is basically a picture of what I look like when I'm trading. And you look like this whether you're making money or losing money. In fact, I think I look like that more when I'm making money than when I'm losing money, because when I lose money, I go into a trade, put in a stop, I'm stopped out, it's gone, you move on to the next one. But while you're in the trade, you're really sweating it out, you're really looking like this most of the time. So it really is a strenuous thing to be in a futures trade. Now, the beauty of the wave principle is you can watch the wave patterns for all different markets. So you don't have to worry about the fundamentals of cocoa. You don't have to worry about the news events. Bob talked about news events yesterday. We're going to set all of that aside and just see what the wave principle tells us today. Keep in mind also that the wave principle helps you anticipate what's going to happen next in the market. And also keep in mind the good old statistic that I'm sure most of us are aware of, 80 to 90% of people involved in the market, or futures market and options market, do not make money. So if you want to make money in futures or options, you've got to be different. And if everybody is focusing on one event or one particular thing in one day, you've got to make sure you're focusing on something else if you want to be in that 10 or 20%. The good part about that statistic is if 80 to 90% don't make money, there's an awful lot of money to be made by only the few who do. So keep in mind that the wave principle is anticipating what is about to happen rather than reacting to something that, or a news event or something that is going to be appearing in the Wall Street Journal. Rather than that, you're anticipating it. One thing I want to review is the degree labeling, so we don't get confused during the real-time trade as to what degree we're using. You see this in both the Elliott Wave Commodity Forecast and the Elliott Wave Theorist, charts labeled with different degrees and I's and 1s. This is what they designate. The Roman numeral 1 and the capital A with no other circle or designation is of cycle degree. Remember the different degrees from cycle down to sub-minuet small degree will be designated like this. Roman numeral 1 for cycle. Circle 1, number 1 with a circle, designates primary degree. A number 1 with the parentheses is the next degree lower, intermediate degree. Just a straight 1 with no other designation, not the Roman numeral, but the number 1 is minor degree. The small I, the lowercase I with a dot, is minute wave 1. The number 1, like the minor, but only smaller, with an underline, is minuet wave 1. This is just stepping down 1 degree at a time until you get to sub-minuet degree, which is way down there. That would just be a very small 1. So these are the numerical designations for impulse counting, 1 through 5. Likewise for corrective counting, cycle degree correction would be by a capital A with no other designation. Circle A, capital A, circle, would be primary wave A. A lowercase a, parentheses, would be intermediate wave A. Just an A without the parentheses would be minor wave A. Minute wave A is a little bit smaller. A underline is minuet wave A, just like the 1 underline. So anytime you see an underline, that's minuet degree. And sub-minuet is a real small a. So when you're labeling a chart, you've got all these different size numbers on there and different size letters. And once you get used to these designations, you can tell what degree you're talking about. In making a forecast and doing a trade, we're going to take the big picture, just like right here, and work our way down smaller and smaller and smaller and smaller. We're going to look at what's the big picture, make that big picture forecast. Then as the market is subdividing internally into that forecast, we're going to take it one step smaller, make that forecast, and as those are subdividing, make that one and that one and that one. So we're going from big to small. We don't start with a 5-minute chart and say 5 waves up, I got to buy, when that may be the end of the fifth of the fifth of the fifth of the fifth of the bigger picture. So we're going to go from bigger degree down to smaller degree. And keep in mind these things. You might want to write these down. These will get you through real-time trading. All degrees of trend are operating at the same time. I'll say that again. All degrees of trend are operating at the same time. When the cycle degree fifth is occurring, that breaks down into primary wave 5, which is also breaking down into intermediate wave 5, minor wave 5. All those degrees are in operation at the same time. This allows us to count Elliott waves in real time. It's not that you're looking at a chart and saying, well, a couple of years ago, this cycle degree 5 wave advance finished. You're counting it in real time because it breaks down into smaller and smaller degree. So the first little 5 waves up on a tick chart, it will eventually lead to 5 waves up on a 5-minute chart, 15, 30, half-hour, daily, weekly. Eventually, in a bull move, that'll translate into a 5-wave move, and that's what allows you to trade real-time Elliott wave. 5 waves up of small degree tells you that something of larger degree is happening, so you can take your position based on your calculations and be around for the move. The second thing is that will get us through real-time trading is all C waves must subdivide into 5 except triangles. That's very important. I used to have a television show. I used to interview Bob on the television show, and one time I asked him, what's your advice to Elliott wave traders? Or what's one main piece of advice to Elliott wave traders? And he told me this third point I'm going to give you right now. When it's over, it's over. When you count 5 waves up of the fifth of the fifth of the fifth of the fifth, it's over. There's 2 things you can do when it's over. You can get out voluntarily, or you can wait for the market to get you out. Either way, you'll get out. What you want to do is do it voluntarily, because it's very, very much more painful for the market to get you out involuntarily. And when you reach that fifth of the fifth of the fifth of the fifth of grand supercycle degree, or supercycle degree is good enough for me, you end up with an October 19th stock market crash if you do happen to hang around too long. So one of the things that will get you through real-time trading is keeping in mind while you're trying to count your trade that the last move is over. In other words, if you already counted 5 waves up and you see possibly what's an ABC down, really that could be a 1, 2, and you're starting to fall into a third because the last move is over. When it's over, it's over. You keep that in mind when we're doing the trade. This leads to point number 4. Don't be afraid to count 1, 2, 1, 2. That goes back to our example. That goes back to this example again. This is not a 1, 2, 3, 4, 5. And you don't always see a clean 5 right off the little bottom, signaling to the whole world that the market is ready to explode and everybody's going to go along and make money. It's more complicated than that, so don't be afraid to count 1, 2, 1, 2. 1, 2, 1, 2. What that's leading to is a subdividing 3, 3, 4, 5. So out of the 1, 2, 3, 4, 5, the 3 was subdividing. And by counting 1, 2, 1, 2, and sticking to the wave principle, third not the shortest, 4 does not overlap 1. This could have come down to here for all practical purposes. By not being afraid to count 1, 2, 1, 2, it kept you long for the center point, wave 3 of 3, payoff, which is what we all live for. The impulse wave is what we're living for. So don't be afraid to see it. Don't be afraid to believe it when you see it. Keeping in mind, of course, the alternate count and your stop losses. Number 5, I'm going to say this over and over and over, and I've said it before, I'm going to say it again. The wave structure is more important than your forecast. We're going to make a series of forecasts to take positions for trades But in all those cases, we're going to remember that those are only common Fibonacci relationships. They don't have to occur. The most important thing is a 5-wave advance, or a 5-3-5, or an ABC. The most important thing is that you count an ABC. Maybe a market is going to do wave 2. Maybe one of these little wave 2s right there retraces so little, maybe it retraces the Fibonacci 0.146, 14.6%. And you're banking on a 382 or a 23%. The most important thing is that it does an ABC down. So the wave structure is more important than your forecast. And I'll give a quote from Frost and Prechter's Elliott Wave Principle, page 168. In analyzing market movements under the tenets of the wave principle, remember that it is always the count which is the most significant. Our advice is to count correctly and never proceed blindly on the assumptions of a preconceived scenario. Despite the evidence presented here, and they were referring to the 1980s bull market forecast, we will be the first to discard our predictions if the waves tell us we must. You have your Fibonacci forecasts, they're fine, they're great, but the beauty of the wave principle is it tells you how to monitor that forecast and whether or not you're going to be right or not. So the most important thing is the wave structure, and that's more important than the forecast or actually the Fibonacci relationships in the end. Let me go over briefly 2 more points that I want you to write down and remember. For real-time trading, in addition to the 5 I just gave you, one would be that our trade is going to be initiated from the preferred count. That may be kind of obvious to most people. You have a preferred count, you're going to trade off the preferred count. In your trading, you're not going to worry about, well, what if this alternate count hits, or if this one hits, I'm going to lose money, so maybe I better just get out. You're not going to do that. You're going to initiate and track your trade from the preferred count, and you're going to place your stop at the point where the preferred count is violated under the rules and guidelines of the wave principle, thereby triggering the alternate count, which then becomes your preferred count. So remember that because we're taking the position before we know whether we're right or not, we need to know exactly what we're going to do when we're wrong, which will trigger the alternate count, which then tells us what strategy to employ after that. Remember, we're only dealing in probabilities. Because all degrees of trend are always operating on the market at the same time, we can go from the big picture down to the small picture, and it follows that points which are found in Fibonacci relationships to several market lengths have a greater likelihood of a market turning point than a point in which the Fibonacci relationship is to only one length. This is again from the PRC manual, the group ratio approach. We're going to take, starting with this big picture forecast, a cluster approach, cycle degree, primary degree, intermediate degree, minor degree. Those are all operating at the same time, and we'll all take the market to its final fifth of the fifth of the fifth of the fifth of the fifth, which is your final peaking point. And there's where all your clusters will be for your next turning point for you to initiate the trade. Let me just touch briefly on one thing, because I keep talking about larger degree down to smaller degree. Some of you who subscribe to the Elliott Wave commodity forecast would have seen in the July issue a little point in Trader's Tips called contained waves. And let me just read how I wrote that in here. Commodities have properties which reflect the universal order that R.N. Elliott discovered. As discussed in Chapter 6 of the book Elliott Wave Principle, one difference between commodities and stocks is that the peak observable degree in commodity swings, depending on the commodity, is usually primary or cycle degree. Therefore, it should not be concluded that a 5-wave advance, such as that which occurred in the grains this year, will lead to further new highs after the current pattern is complete. Contained waves in commodities mean that the entire bull market is limited to a single advance of primary or cycle degree. More information on that is in Chapter 6 of Elliott Wave Principle, but the important point is, if you see a 5-wave advance of primary degree in stocks, that would lead to a 5-wave advance of one larger degree, cycle degree, which would lead to supercycle, grand supercycle, reflecting the growth and decay pattern of mankind. But in some commodities, you have contained waves. So the 5-wave move in soybeans during a certain cycle of primary degree or even forming a cycle degree advance is the entire bull market and will not necessarily be the first move of a larger supercycle degree bull market in soybeans or certain other commodities. So that a move in some of the grains now, a 5-wave move now, would be unrelated, Elliott wave-wise, to the move, say, 12 years ago. Now, the currencies, as we'll show, will have larger degree moves. So the contained waves in soybeans or grains or some of the other commodities will be a little bit different than the supercycle degree waves that are occurring in the foreign currencies of the US dollar. So keep that in mind when we're talking about commodities. And at this point, it just comes to taking charts and starting to label them yourself. We've gone over all the rules, the guidelines yesterday, the probabilities. At some point, we just need, the best thing to do is just take some charts and start labeling them. So right now, what we're going to do is take a look at this dollar chart. This is on your handout. This is a chart of the Princeton US Dollar Index, which is kept by Martin Armstrong of Princeton Economics. Supplied the chart, and I labeled the chart. And this shows the US dollar. This is the US dollar's foreign exchange value versus a basket of currencies. Going back to 1900, this has been in the Elliott wave commodity forecast, but the main point here is that only the first 4 waves of the necessary 5-wave sequence to complete the advance have been completed as of December 31st, 1987. This is very similar to the position the stock market was in 1982. In fact, when Frost and Prechter wrote the book, they had a similar situation. The transparency which you saw yesterday showed the stock market at the 1978 point when they wrote the book, showing the first 4 waves complete. The dollar is in a very similar position. So again, we're going to go from big picture to small, and we're going to take our appropriate vehicle. In other words, we're going to go long the dollar, or we're going to sell short a foreign currency, whatever the case may be. In this case, we're going to do the Swiss franc. What we're going to do is look at the 5-wave advance, or the first 4 waves of a 5-wave advance, showing that we're expecting a 5th wave of cycle degree to a new high in the dollar above the 1985 high. Do we know if this is going to happen yet? No. But we track the structure of this decline, which occurred in 1987. We're going to go from this 90-year chart, the big picture, the supercycle picture, down to one smaller degree, and we're going to take a look at this section right here. But taking it down one smaller degree, we're going to look at the structure of wave 4. This should be on the other side of your handout. Now we're switching to the US dollar index, traded in New York. This is no longer the Princeton Economics dollar, and this is the US dollar index where those futures traded in New York. We see that from 1985, where wave 3 ended, cycle wave 3 led to cycle wave 4. It was a double zigzag structure, ABC, X, ABC, ending December 31st, 1987. But what we're going to do is we're going to take it just a little bit before this December 31st bottom, and we're going to go back to October or November before that bottom, because we're doing our analysis based on expecting the dollar to bottom and the currencies to peak. We want to take a short position in the currencies or a long position in the dollar. In this case, we'll track the Swiss franc trade. So backtracking to last October, where we only see this part right here, you're in wave C down, the final wave C of a double zigzag for cycle wave 4. Let's move over to the Swiss franc. Now we go over to the workbook. This is a monthly chart of the Swiss franc last October. Now the dollar being in a corrective wave down, a double zigzag down, would mean that the Swiss franc is in a corrective wave up. We want to short sell Swiss franc futures. We want to forecast where are we going to short these. We're not in the market right now at all. We're starting a fresh trade. Going back to 1972, again, we're going to a little bit smaller and smaller degree as we go. Now we're down to primary wave A, B. We're looking for primary wave C, forming an ABC rally in the Swiss franc. And we're going to take our group ratio or our cluster of trades to tell us where are we going to short the Swiss franc. At this point last October, the first 4 waves of wave C had been complete. Now you have an A, double zigzag B, and all C waves must be 5 waves, so we're looking for a 5-wave C. In fact, the first 4 waves are complete. There's a couple of things happening here. One, third is the extended wave. So going back to the transparencies we reviewed a little bit earlier, what are the most common relationships that we're going to look at? In other words, where are we going to short sell the Swiss franc? First of all, of larger degree, most commonly, wave C is equal to wave A. So in the November issue of the commodity forecast, primary wave C would be equal to primary wave A at 77.70. Put a little mark on your chart. Write down 77.70. In other words, take the net distance the wave A traveled and add that to the B wave low, and you have your first Swiss franc target, 77.70. But since all degrees of trend are operating at the same time, and this is a monthly chart, we can now go down to the weekly and the daily chart to watch this 5 of C develop, because all C waves must have 5. In fact, the 5th will have 5, and that 5th will have 5, so we can track this trade as it comes into our target. So once wave 4 bottoms, which is shown right here, we can then come up with the wave 5 projection. Now remember also, most commonly wave 5 is related to wave 1 by equality. Then next most commonly 1618 and then 618. So you take 5 is equal to 1 and you get another point on your cluster, 75.90. Again, put your line there, 75.90. Still working off our monthly chart. And 5 is 1618 of 1 at 78.60. So now you've got 3 points there. Now you're starting to see a Fibonacci zone where the Swiss franc is likely to peak. Remembering that this is a forecast and a likely relationship, but the most important thing is what? The wave 5 subdivides into 5. So how do we develop a strategy off that? Where do we want to short the Swiss franc? Okay, somewhere, this is still last November, between 75.90 and 78.60, and there's a number at 77.70. So between 75.90 and 78.60, you want to move into your short positions with a stop above that area. Now as wave 5 progresses, you watch that subdivide, and you keep coming up with confirmations. As waves 1, 2, 3, and 4 occur, you go 5 equals 1 within 5 in a smaller and smaller degree until you're adding to your cluster. You're coming up with continued points until you've got a bigger and bigger cluster of numbers, and the more they fall in that range, you've got a good case for selling the Swiss franc there. In fact, it was such a good case that you would feel that I'm going to take a full 100% short position in the Swiss franc, and if I get stopped out, fine, I'm going to lose money, but this is such a good cluster of numbers. Why am I doing Elliott wave if I'm not going to short sell the Swiss franc here? If it doesn't occur, then something else is happening, which would then be, if you shorted based on these numbers and got stopped out, wave 5 would probably be extending. But we know that's unlikely because usually one of the 5 waves is extended, and here wave 3 is clearly the extended wave. So we've got our cluster. My particular strategy was to move to 50% short the nearby or the most active Swiss franc contract at 76. and take a full 100% short position at 77.70 with a stop at 79.60. In other words, as it comes into the bottom end of that cluster, the lowest number was 75.90. As it hit 76, the very bottom end of that cluster, I take a half short position. And as it moves farther into that cluster, I want to add to that into strength with a stop above the cluster. As it turns out, the next page in your workbook will show what ended up happening. I don't want to make this sound easy. I have full confidence in Elliott wave numbers, but this was a tough one. The currencies have a very high percentage chance of rallying the final week of the year. The volume gets thinnest between Christmas and New Year's. The Swiss enters the target zone. My short position goes off, and it's just inching up. Every day the Swiss franc is rallying. But meanwhile, my stop is at 79.60 on a 100% short position. And I'm starting to look more and more like that first page in the workbook. And I'm crawling into Bob's office on December 31st. And the Swiss franc is at 79.50 with 10 more minutes of trading. And I'm crawling on the floor into Bob's office going, they're going to get me on the last day of the year. I know these currencies are history after this. They're going to get me. I'm in a full fetal position on the floor. And the market closed at 79.55 on December 31st and did not stop me out. That's the power of the Fibonacci numbers, but also maybe a little bit of luck. Anyway, we're 100% short the Swiss franc. You have a good New Year's party that night because you're really worried about that one last nickel that might happen after the first of the year. But we said a lot of prayers over the weekend, and now we're going to track the trade. We're 100% short. Our stop is at 79.60. What I've done in this example is taken the September Swiss franc, which is a current nearby month, and you're going to have to take into consideration the rollover and the difference in premium. Initially, it was shorting the March Swiss franc, then rolling to the June, but we're going to track the September. So the equivalent September stop instead of 79.60 would be right above this December 31st high, which is shown on the next page, which is the first week's worth of action after December 31st, 1987. Or actually, this is December 31st, this top bar right here. And that's actually above the 81 level on the September contract, which is equivalent to the continuation chart, the monthly chart figure we came up with. So we're going to track the September Swiss franc all the way down. You can see that it gapped up on December 31st and closed on its high. The next day, the first day of trading, which I guess was January 2nd or 3rd, 1988, the market did a full gap down, thereby making you feel a little bit more comfortable. Now you can get up off the floor and go sit down. The next day was an even larger gap down. The next day was an even larger gap down. Now, what's this telling you, first of all? How do we count this decline? This is a daily chart. I don't have the hourly right here of this particular decline, but it did subdivide into 5 with large gaps in it. In fact, it was a very, very sharp, just about a 10% drop in the currencies in only 3 days. That tells you two things. One, you're expecting a primary degree C wave peak and a cycle degree fourth wave bottom in the dollar. What usually happens after that? A major change in direction. A 10% drop in 3 days is a major change in direction. So, again, in real time, we came from in a fetal position on the floor to a little bit of added evidence that, hey, maybe this preferred count is right. Of course, you never had a doubt in your mind. This subdivides into 5. How do we label it? Based on what we learned. In fact, let's just take this first period right here, 5 waves down on the hourly. Now our preferred count is looking for 5 waves up in the dollar, 5 waves down to a new low in the Swiss franc on that long-term monthly chart. So this is going to be, under our preferred count, the first 5-wave decline, the first wave down of a larger 5-wave decline down. So we're going to label this under the preferred count 1. Now you can write, the workbook is set up so that we're going to turn a page at a time, and it's going to show you about a week or so at a time. And you can keep labeling this as we go so you can see the unlabeled pattern and label the real pattern. This is going to be wave 1, 5 waves down, or what's our alternate count? Our alternate count was that 5 waves into 79.55 was just wave 1 of 5, and it's not the completed fifth. So our alternate count would be that this is A of 2 of 5 of C. Hopefully I didn't lose anybody there. But back to this chart. This is waves 3, 4, and 5. This is our preferred count. Under preferred count, it's over. Under the alternate count, this is only wave 1 of 5, and it's going to do it 2, 3, 4, 5, and complete the whole pattern. Above A equals C, but really, if you get stopped out, the next most common relationship is C would be 1.618 of A. That's way up there. So you want to get yourself stopped out if you're wrong. You don't want to hang around for a move to about 100 on the Swiss franc in a short position. So our alternate count is that this first 5-wave decline right here is A of 2 of 5. Another alternate count would be that we miscounted this, and maybe this is the top of intermediate 3, and we haven't done the 4 or 5 yet. I mean, we're trying to think of all possibilities. So another alternate count would be that this is forming intermediate wave 4. We don't want to complicate the picture, but we want to keep all alternate counts in mind. So this is basically 1 or A of either 2 of 5 or intermediate 4. Now that immediately tells us other things. First of all, we've got evidence. We're short. We're now at a profit. Our stop is still at 79.60 or 81 on the September contract. If we're wrong, we're going to do an A, B, C down of 2 or 4. So what's happening? The preferred and the alternate Elliott wave counts tell us to be short. What a beautiful strategy. That means if I'm right, I should be short, and if I'm wrong, I should be short. Not only that, but we've done 5 waves down, adding evidence that the currencies have peaked. Let's go on to the next page, showing some more of the trading. Now here's where we get down to some of those fine points of real-time trading that I was talking about. Again, this is preferred count, 5 of C. And this is wave 1. Let's just label the preferred count. What happened here? We have an A, B, C to a new low. A, B to a new low, C. Forming 2. Okay, remembering from yesterday the alternation guideline, we've got 5 waves down, wave 1, and irregular or a flat wave 2. So now we know that wave 4 will probably alternate with this wave 2 and be of the sharp family, of the zigzag family. That may or may not happen, but more often than not it does. The important thing is, suddenly for the first time in 3 years, when that C wave showed that the Swiss franc was rallying in 5s and dropping in 3s, what's happening? It's now declining in 5s and rallying in 3s. It just turned itself inside out, and now the 3 waves are rallies. If it's anything you get out of Elliott wave, if you're confused on the count, you have no idea which one of these are right, it's remember that 3-step is counter trend. So you don't know whether the currencies have peaked. Maybe you couldn't count the advance, but you see a counter trend rally for the first time in a long time, and you think, I got to sell the rallies. Not only that, but there's a 5-wave decline. Even if this is an ABC, I still have to sell the rallies. If the preferred count is right, we're going to get a big payoff. So you've got an ABC. Now we get down to the fine-tuning. Is this an ABC decline under the alternate count? But the biggest hint here is all C waves must be 5. That has the look of an ABC, but is it an ABC? In other words, should I cover my shorts there, or should I go long? The answer is no for 2 reasons. 1, this, quote, C wave does not subdivide into 5. And 2, your preferred count tells you that that's not a C, but the start of a 3. So two reasons why you don't want to cover your shorts, even though it has the outward appearance of an ABC. Now let's track this third wave down. 1, 2, 3, 4. No rule violation, no overlap. The 4 is getting a little high. It's starting to make you nervous again. You've had your wave for a couple of weeks. You're starting to get a little bit nervous because the 4 is getting a little high. In fact, guess what this drop was? That was about a 10-minute trade deficit drop in the currencies. So people are still bullish on the currency, so they bid the Swiss back up to this level going into the trade deficit, because the trade deficits in the prior months had been so, quote, bullish for the currencies that this time it turned out less than expected for the first time in a while, and you had about a 10-minute drop down, but the psychology is still bullish. You're only in the initial first 5-wave decline. The psychology is still, okay, so it's a pullback in the currencies, let's buy it. But you know, based on your Elliott rules, that when it's over, it's over. Let's look at another page, the next page. 5 of C, 1, 2. Now here's where the degree designations come in, and you may want to refer to the notes you took down. But we're looking for minor wave 3 to subdivide because it already did a 1, 2, 3, 4 on the last page. So we want to start labeling those 1, 2, 3, 4. Now what's happening again? Wave 5 of 3, or alternate count wave 5 of C, is now subdividing in itself, which tells you it's a good thing I followed the rules of Elliott, because that kept me short when it had the appearance of a C wave, but it would have violated the rules because a C wave can't subdivide into 3. So that kept me short at least for this new low. But now what happens? You've got a 1, 2, 3. Again, you're at a new low. That could be 1, 2, 3, 4, 5, but the 5 must subdivide into 5 itself. So you wait for that 5 to finish subdividing into its own 5 until you come down here. In fact, wave 5 of 5 ended up being a diagonal triangle. I'm sorry, 5 of 3. So that you have 1, 2, 3, 4, 1, 2, 3, 4, diagonal triangle, 5, 3. Alternate is A, B, C. Let's expand the alternate count a little bit more. ABC of intermediate 4. Maybe intermediate 4 is done. Or ABC of minor wave 2 of 5. Again, back to that weekly chart. This is either alternate count 2 of 5 or 4. In order of lesser and lesser probability, the highest probability is 1, 2, 3. A lesser probability is ABC of 4. An even lower probability is ABC of 2 of 5. Maybe this ABC is only the first ABC of a triangle 4, or the first ABC of a double zigzag 4, or the first ABC of a triple zigzag 4. So these remain low probability alternate counts, and our preferred is 1, 2, 3. And the action after that ends up being a 4, 5. 1, 2, 3, zigzag 4, 5, 1. A flat 2, zigzag 4, rule of alternation, a sideways and a sharp. Wave 3 is not the shortest. You have 5 waves down. Following all the rules, you didn't break any rules. You followed all the rules all the way down. You now have your first 5-wave impulse wave down forming intermediate wave 1 of 1 larger degree, which immediately adds information to your arsenal. Not only is your short position profitable based on the wave principle, but now you have 5 waves down of larger degree, telling you that if the alternate count kicks in, maybe this is only A. Now you've really got a big one. A, B, C. Now you're looking for lower numbers. Each time evidence is added to increase the probability that the preferred count is in effect and lowering the probability of an alternate count because of the 5-wave down of 1 larger degree now. So the first 5-wave down could have been a small ABC, but the larger 5 waves down means that that's at least a bigger one, or more likely your preferred count is in effect. Now there's some more things we can do with this 5 waves down. One, we can project the retracements for wave 2. Remember the most common retracements. 0.382, 0.618, 50%. Now these are going to be guidelines, and it's going to be a forecast. In other words, if you were putting on a forecast, or writing down a forecast, you would base it on these Fibonacci numbers. You'd also see where your cluster again occurs with some of the other Elliott wave guidelines. Remember that an ABC rally will usually resist in the previous wave 4 of lesser degree. So if your cluster of retracements for your expected wave 2 counter-trend rally lands in the previous 4th wave of lesser degree, then you have added evidence that that will be another resistance point that will lead to further declines in the currencies. As it turns out, wave 1 was 8.6 points long. Take this number where the peak was, minus this number. You came up with 8.60 points. Now let's forecast where wave 2 is likely to be, and you can adjust your strategy depending on how short-term you are. A position trader looking for a major collapse in the currencies would want to ride the whole 5 waves down, or primary wave 1 down. Shorter-term trader would say, well, this decline has been going on for almost 2 months now, and we're going to get a rally. I've got to roll out of this March contract into the next one. Besides, sentiment has finally turned more bearish towards the currencies. People are finally saying, well, maybe these things have turned direction. In fact, the trade deficit got bearish for the currencies, bullish for the dollar. So your market sentiment, all your things are starting to fall in place for a short-term low or an intermediate degree low in the currencies. So if you want, you cover your position down there, understanding that that may be just one of 5, and you're going to leave on the table 2, 3, 4, 5. Wave 3 was the extended wave, so wave 5 is just most likely just to be a short wave 5. Maybe it'll be equal to 1, maybe it'll be 61801, but it fell below wave 3, so we cover the position. Wave 1 was 8.60 points long. Multiply by 382 to get your first target, and you're looking for a 3.285 point rally. What you're doing is you're developing a cluster here for your initial target for wave 2. And you also can look over here and see that it's just above the previous 4th. In fact, there's another 4 over here. You're in the zone of the previous 4th. Now, that can retrace 618, but this is just our initial forecast. And what we really want to do is look for an ABC. That's the only requirement. The 382 and the 618 is a guideline, but we're looking for an ABC rally or a double zigzag or a flat, but it needs to trace out an ABC. Those are the most important parts. Going on to the next page, there's your 5 waves down. 1, 2, 3, 4, 5, forming wave 1, alternate A. After that, you did an ABC. In fact, it was real close to your 75 number and real close to the previous 4th. ABC. Above the previous 4th, in this previous 4th, it's in your cluster of initial targets, and it traced out an ABC, so can we label that 2? A, B, C, 2. Or, what are the possibilities? 2, A of 2, in case it's a flat, and this is B down, C up, 3, 3, 5. Wave 2, you won't see a triangle. A triangle occurs in the B wave or the 4th wave position and precedes the final move. So you're not looking for a triangle on the preferred count, but it could be a zigzag, a flat, double zigzag, triple zigzag. There's still a lot of possibilities. So we can label this ABC of 2. It's right into our zone, so if you cover down here, you're reselling with a stop above this resistance, because if it breaks through that and does an X, it's going to do another ABC, which is most commonly equal to the first ABC, and it'll probably go to a 50% or 618 somewhere up here. So you want to take, again, the same approach we took at the top here. Resell the rally, or if you're a position trader, you might want to add the positions there with a stop above there on the positions you added, and resell up there if that occurs. As it turns out, as you can see right here, that it did drop straight down after that again. That's a straight line down on the daily chart, so you need to look at the hourly to see if that's subdivided into an A, B, C, or a 5 to see if we're going to start the next move down. What we'd be looking for, if this was a 3, would be a 3, 3, 5 flat, right back to where we originally sold, forming a 3, 3, 5 flat correction, and we would change this 2 to over here. But for now, before we come back the next day's trading, we're leaving this wave 1 down, wave 2 up, and we've resold this Fibonacci zone in the previous wave 4, and again, 5 waves down, 3 waves up, 3 waves up, counter trend. As it turns out, you can see the 3-step A B down, and a 1, 2, 3, 4, 5 C, forming a perfect 3, 3, 5 flat. You remember this from page 2.26 yesterday. 3, 3, 5 flat. Right there. In fact, again, because all degrees of trend are operating at the same time, we can continue to break this down and down and down from the daily to the hourly to the 5-minute. Let's take a look at this wave 2, and let's take a look at this 5-wave advance and go from the daily 5 and move it down to an hourly 5. You can see the Elliott in progress on the hourly 5. This is the June Swiss franc, by the way. But there's B down to a new low, followed by a 1, 2, 1, 2, 3, 4, extended 5, 3, gap right in the center point. Remember, this is your real time. Now you're going hour by hour. Gap in the center point, 3, ABC 4, 1, 2, 3, irregular 4, rule of alternation, 5 of C. Now that 5-wave advance we just saw on the daily subdivides into 5 of C on the hourly, telling us, since all C waves must subdivide into 5, that this has to be the end of a flat correction. Not only that, but it's followed by a 5-wave decline on the hourly. So once you see that 5-wave decline off the high, what's happened? You've got 5 waves down in the currencies, you've got an ABC back up, followed by another 5-wave decline. Now, you're into April. Now, ever since the very beginning of January, you've been declining in 5s and rallying in 3s in the Swiss franc, over and over and over. 5 waves tells you that the larger trend is down. 5 waves, and that tells you that that larger trend is down, and that's what keeps happening. As soon as you see this 5 down, you can eliminate the rest of the double zigzag possibilities. This was a straight flat. That is wave 2. We're now starting wave 3 down. In fact, let's go down one smaller degree, and let's take a look at this 5th wave and this rally, and look at the 5-minute chart. So now we've gone from a 90-year chart to a monthly 15-year chart to a daily to an hourly. Now we're down to 5-minute. And you can see the Elliott waves in operation again. This is that 5th wave down, right off that flat correction. And you can see that subdividing into 5. 1, 2, 1, 2. Thirds the longest, 3, 4, 5 of 3, forming the whole third, 4, 5. 5 waves down in the 5th. And then, subsequently, on the 5-minute chart, you can see that this is clearly corrective action. Nowhere is there this kind of impulse back to the upside. You've done 5 waves down. You're looking for an ABC. 1, 2, 3, 4, 5, A, B, 1, 2, 3, 4, 5, C. As it turns out, on the 5-minute chart, it did X, 1, 2, 3, triangle 4, 5, A, B, and then after this it did do a C. You can label this 1 and this 2. So what's happening here? We're still declining in 5s. We're rallying in 3s. Not only that, but it appears that under the preferred count that the payoff is finally here. In other words, we've done back a step here. 1, 2, 3, 4, 5, A, B, C, flat. What's happening now? We fell in the first 5 waves down of wave 3 of 3, the point of recognition, most dynamic part of the decline of the Swiss franc. And the thing that has kept us short is just following the rules of Elliott wave in real time. Again, 1, 2, 3, 4, 5, wave 1, A, B, 1, 2, 3, 4, 5, C of 2. That first 5-wave decline we saw, and then the ABC on the 5-minute chart is this 1, 2, 3, 4, 5. There's another 1. What we're going to do is subdivide the third wave. In other words, this 8.60 point long first wave, we can now get a target now that wave 2 has peaked for wave 3. Multiply the distance that wave 1 traveled times 1.618 and you get your net travel that you expect wave 3 to take, which is going to be over 13 points long. These happen to also be Fibonacci numbers. 8-point first wave times 1.618. Your target is for a 13-point third wave from the 75 and change peak is going to give you a downside target of 62.25 on the Swiss franc for wave 3. So we're going to keep that in mind, that it's a target. The most important thing is 5 waves down, but because the third can't be the shortest, we're going to expect it to be longer than 8.60 points, at least. And this is just wave 1. In fact, you can even add the positions there, because there's another trade deficit report, only this time it's interpreted as bullish for the Swiss franc. The trade deficit, after changing direction and showing as bullish for the dollar, finally showed bullish for the Swiss franc and led to another one of those 10-minute straight-up moves, scaring you half to death. But you've got your preferred counts, you've got your stops in place. Position trader stop is up there. A person who covered here and resold this area here has a stop above this Fibonacci zone. In fact, you can put it right above that high now, because we did 5 waves down off of a flat, and that is wave 2 under the preferred count. You can put your stop right there. So they can come out with all the trade deficit reports they want. They can come out with whatever they want. Your stop's in place. You can hide under your desk during the report. It's a 10-minute straight advance. I do that. When Debbie comes in my office, Debbie's my secretary, and I'm hiding under my desk, she knows there's a trade deficit report out. But I put my stops in place before I hide under the desk. So it goes up, I come out, I see it didn't stop me out. If it goes above this number, something is terribly wrong. We've followed all the rules. It's an ABC flat. If I get stopped out, I got to go back to the drawing board. Something's wrong with my wave count. 1, ABC 2, if I get stopped out, something's wrong with it, trade deficit or not. This is a 5-wave decline, further adding support to your preferred count. Let's see what happened after that. And remember, don't be afraid to count 1, 2s. Here's your C of 2 again of the flat. 1, 2. We can see that by the next day, the Swiss franc started keeling over again. Why? Because it's extremely bearish, wave 3, directly ahead. In fact, you've subdivided the first 1, 2 of 3. Now you're coming to the center point, wave 3 of 3 decline of the Swiss franc, right after a supposedly bullish trade deficit report. Your stop is still right here. As long as it doesn't exceed that, you're going to stay short. We're going to start subdividing these declines. If you remember your degree labeling, if this is 1, 2, we're going to look for a good size wave 3 of 3. So we need to subdivide the I dot 1 degree smaller. This is minor degree. We need to go 1 degree smaller and start subdividing minuet and minute degree. So 1, underline 2, 3, 4, 5, 1. That's the way we could label this right now. Now the 2 waves are going to become shorter and shorter because they're within a larger third wave collapse. 2, 1, 2, 1, 2. We don't have enough information yet. Let's just keep riding out the 1, 2s and look at the next page. Now you can see it beginning to accelerate. You can see the slope of the move beginning to accelerate down like that, like a third wave should. Meanwhile, your stop is still there. Minor wave 1, minor wave 2. This subdivides all the way down to 1, 2, 1 degree smaller than minor wave. Now you're expecting wave 3 of 3 of 3 of 3 to just basically collapse right down through support. Just keep paging ahead to this. 1, 2. 1, 2. Now let's start counting the subdivisions here. This is where you've got highly negative momentum. The market is subdividing. Got a downside target of 62. You're only at 68, so let's give it a chance to unfold. In fact, if this is forming an ABC under the alternate count, and A equals C, it still should be 8.60 points long. So you're still looking for lower numbers. 1, 2. Then you can see another 5 wave. 1, 2, 3, 4, 5. See 1, 2, 3. Another trade deficit. 4, 5. 1. Again. This is minor wave C of intermediate wave 2. So in order of higher degree down to lower, intermediate 1, 2. We're in intermediate 3, parentheses. Within that, straight number 1, straight number 2. We're in wave 3, straight number. Within wave 3, we're in 1 degree smaller, the I dot and the double I dot, 1, 2. We're in wave 3 of 3, which is not done yet. Within wave 3 of 3, we're 1 degree smaller, underline wave 1. Now we're getting down to minuet and subminuet degrees. These are subminuet degrees. So now, 1, 2, 1, 2, 1, 2. In fact, we have 1, 2, 1, 2, 1, 2, 1, 2. So we've come all the way from above 81 on the September Swiss franc. We've come all the way down below 70, and we're still counting 1, 2s under the preferred count without violating any of the rules. We're well on our way to the target for wave 3. And under the alternate count, it's A, B, C, not done yet. But we're just going to keep counting this in real time all the way down. Again, everything characteristic of a third wave is happening. It's becoming the longest. It's beginning to accelerate to the downside. Fibonacci relationships abound. It's falling in 5s, rallying in 3s. You're still not, this is 65, you're still not at your 62.25 preferred target, and you still can't count a completed 5 down. C of 2, again, minor 1, minor 2. 1 degree smaller, 1, 2. Underline 1, 2. Small, 1, 2. Now we're going to subdivide 3 of 3 of 3 of 3. 1, 2, 3, 4, 5, 3. One of the keys to counting this is seeing each one of these in its own form. And you can still break it down to hourly charts or 5 minutes, whatever you have to do. But to see that this is a 1, 2, 3, and within this 3 is a 1, 2, 3, 4, 5. Each one subdivides into its own 5, which subdivides into its own 5, which subdivides into its own 5, until you're down to a tick chart of each trade, which you can't possibly get any smaller. It's following these rules and knowing that at least the market is still falling in 5s and rallying in 3s and has not fulfilled even the alternate count projection that keeps us short. Your momentum oscillator is beginning to fall to new lows. Sentiment is turning from extreme optimism in the Swiss franc, moving down towards maybe the neutral zone. In fact, we're in the point of recognition stage, the center point wave 3 of 3, where people finally say, uh-oh, these currencies are going down. Now the banks, everybody starts coming in hedging. They start flipping into U.S. dollars out of foreign currencies. They can cite whatever reason they want, bullish trade deficit for the dollar, higher interest rates, whatever the reason is. The point of recognition comes in mid-summer, 6 months after the peak, which is why we need to take the position before we even know the reasons why this particular move is going to happen. We needed to anticipate a 5-wave decline. In fact, it took this long before it even began to accelerate, wave 3 of 3 to the downside. The key again is each one of these, you can find 5 waves in them. Each one of these, by following the rules, subdivided into 5, and the rallies were 3. By following the rules, it got us through. 1, 2, 3, 4, 5. Within that, that was 5 on the hourly. This is 5 on the daily. That's 5 on the hourly. We saw the wave 2 structure on the hourly, 5-minute daily. 5 waves again, 5 waves. Everywhere you look, 5 waves down, 5 waves down. In fact, it's still falling in 5 waves. It's still not at our 62 target. And this is only wave 3. This is still only intermediate wave 3, or alternate count, intermediate wave C. The alternate is listed down here. Alternate wave 3. Instead of wave 1, this is A of 4, B of 4, and this will be C of 4. Or the other one we had was, this is 1 of 5. This will be A, B, C, 2 of 5. And now it's getting awfully deep. In fact, we can eliminate this alternate count altogether. In fact, as soon as we fall below this point right here, whatever that wave 4 low was, this can no longer be wave 2 of 5, because wave 2 cannot go below the origin of the original advance. So once we fall below this point, which is a little bit above our 62 target, you eliminate that count, which is already extremely low probability, but still keep the wave 4 count in case you miscounted this whole thing. Now the Swiss franc, after that particular page is labeled, this will update it all the way into now. But just to continue the subdivisions, this is C of 2, again the flat. Wave 1, 2, 1, 2, 1, 2. This is what we already went over. 1, 2. Each one has 5. Now we can finally start counting 3, 4, 5, underline 3. We're subdividing 3 of 3. Underline 4, 5. Whoops, this should be 4, 5. There's your third of the third. We're still in intermediate wave 3. We're still in minor 3. Within that, we subdivided 1, 2, 3. 4, 5, minor wave 3. We're still not done with the third. 1, 2, 1, 2, 1, 2, 1, 2, 3. Now we expect to do nothing but count 2 numbers now. 4, 5, 4, 5, 4, 5, 4, 5, 4, 5. As many 1, 2s as there were, there will be 4 5s. After that, you have minor wave 4, 5. Now you're done with intermediate wave 3, and look where it landed. 62.25. In fact, on the weekly chart, we can see what that looks like. This is in your workbook, the next page. That's what the whole decline looks like. Back to our weekly chart. Wave 1 down, this is a continuation chart, a compilation of all the nearby futures contracts. The one we tracked was September. This is continuation weekly. 1, 2, 3. You can see the 3 subdivided into 5 as we saw in the daily. Now we're done with wave 3. We're expecting a wave 4. We can do our calculations for wave 4, and that's taking us into where the Swiss franc is at this time. But you can see several things happening on this chart. First of all, the point where 3 would have been 1618 times the length of wave 1 was just below where we bottomed. That was one of our target clusters. That's just below 62. In fact, I believe it was 6180. Another thing we can do is take this whole 5-wave advance, calculate a 0.382 retracement, which is not a target but support. And we come up with this exact point here, 62 again. There's another cluster. You can also subdivide 5 equal to 1. 5 is 1618. You're coming up with clusters and a lot of reasons to cover shorts and expect an end to wave 3. right there. Not only that, but if your alternate count hits, where this is A, B, C of 4, and you miscounted this, and you're going to go to one more new high, this is where 4 is most likely to bottom. You want to cover your shorts because your preferred and alternate counts now have you covering shorts. Another thing happened is, in argument for the preferred count, this parallel channels beautifully. And the fifth wave, the one that occurred basically the last week of December when I was crawling on the floor in Bob's office, was throw over this channel. After that, it got back into the channel the next day and immediately started falling in 5s. Since then, we've been tracing out a wave 4 right off of this support point. The preferred count calls for a fifth wave down, and you can again do your calculations. 4 should retrace no more than 382 of 3. 1 should be equal to 5. Third should not be the shortest. Next most common, 5. The same calculations again. Also, notice that we held so far in previous wave 4 support. By breaking that and doing a fifth wave down on the Swiss franc, you can then, again, of one larger degree, have a 5 wave down forming wave, primary wave 1. Notice we keep going to larger and larger degree. The whole time we were short, we did not know if we were right about the peak in the foreign currencies. In fact, we still don't, because the alternate count calls it an ABC4. But the balance of evidence shows the preferred count should result in a 5-wave decline. Once that happens of primary degree, you have a strong case, very strong case, for a major drop in the Swiss franc. Let's take a look at what the US dollar index was doing that entire time. You can see the exact same relationships coming off the bottom of the US dollar index. Exactly the inverse of the Swiss franc. There's the cycle wave, primary wave C of cycle wave 4 bottom that we saw in the 90-year chart. And it was followed by a 1, 2, 3, 4, 5, ABC 2 down. Now you see the same relationships, 1, 2, all the 1, 2s. We could do this exact same thing inversely for the dollar. 3, 4, 5. 3 was 1.618, 1.618 times the length of 1. 2 retraced almost exactly 0.618 of wave 1. Wave 3, again, the same relationships we saw before with the Swiss franc. So while you're tracking your Swiss franc trade, you have the benefit of looking at the wave counts of other currencies, especially the US dollar index, which is the basket of the currencies. But chances are the other ones are going to be following the same patterns, and you want to keep an eye on those too. This chart appears periodically in the Elliott wave commodity forecast. This is the ideal 5-wave structure, forming 5 primary waves, which would, for the dollar, form cycle wave 5. We just tracked the first 3 waves, first 3 intermediate waves of primary wave 1. So if we were to draw a map of where the dollar is in terms of the ideal, at this point, the idealized Elliott wave structure, we would now be intermediate wave 4 of primary wave 1. Alternate count, ABC of 4, and you go to a new low, then start the advance. Or, by the other alternate count shown on your handout, the one down here, if this is instead of wave 3 from the year 1900 was wave 5, this can be counted. At the very bottom of the page is listed the alternate count, which is by nature a much lower probability count. Primary 1, 2, 3, 4, 5 forming cycle wave 1 down, in which case we would be looking for an ABC backup, and we could use the same retracements, 382, 50%, 618. This would most likely form 5 intermediate waves forming wave A, B, C, counter trend, rally. Still much higher numbers in the dollar, but in that case, we'd block out this and we'd be right there within an ABC rally. But the preferred count shows that you're only right there of a larger idealized textbook 5-wave advance in the US dollar. This does appear periodically in the Elliott wave forecast. The same calculations were done for other currencies, such as the British pound. We're not going to go into this too heavily because I want to get into some more real-time trading, but from 1972, again, like the other currencies, we did an ABC where this B wave retraced 6 1/8 of this decline. A was equal to C, and it fell within about a nickel of the Fibonacci relationships and then fell out of bed. But you can track the other currencies to give you support to the wave counts you're tracking in the particular contract that you're trading. Let's go over to one that's even a lot more difficult than that one. This platinum one is very tricky, but following the rules will get you through the trade. And it was done in the Elliott wave commodity forecast. This is a long-term chart of platinum, which is basically following the same pattern that the Elliott wave theorist has for gold. This was wave 5, A, B, C, and it's tracing out an X, A, B, C on a long-term basis, double zigzag, bearish pattern. Platinum's the same thing, but what we're doing is we're going to pick up platinum after this 5-wave decline, followed by this rally, forming waves A and B, or 1 and 2. We're going to trade this particular decline here, which starts here, page 3.30, where you can label this wave A, this wave B, coming up to above 650 towards 660, $660 an ounce. We're looking for a 5-wave decline. We're short selling platinum with a stop above Fibonacci resistance. And here's what begins to happen after we initiate the trade. There's your first drop. This is page 3.31. Your first drop, your first rally. Maybe it's 1, 2. Maybe it's minor 1. Maybe it's minor 2. Maybe it's only 1, 2. We need more information. We don't have enough yet. We just know that it's subdividing into 5s on an hourly chart. Going one more page, we do see that it's 1, 2, again, 3, 4, 5, forming 1. A clean 5-wave decline. But as soon as you see the 5-wave decline, your stop goes right above that high. But we want to keep this going as long as it's falling in 5s and rallying in 3s. We want to stay short. There's the first 5-wave decline, 1. Our stop goes there. Now we're looking for an ABC, wave 2, 1, A, irregular B, C. We can label that 2 now. Or A of 2. Now you're looking for a 5-wave 3, so you definitely want to be short under the preferred wave count. You want to cash in on this 5-wave 3. That could be 1, 2 of 3. Still need more information. The next page reveals a few more days' actions. 1, 2, or A of 2, but now look what happened. We were labeling that 1, 2 looking for a collapse, but it supported and started coming back up. So this could be doing A, an irregular B. By an irregular B, I mean a 3-step B to a new low C, back up, forming an irregular flat 2. But now what happens is that. This is not an easy pattern. But you're still short with a stop there. 1, 2. Now what can we do? 1, A, B. How about a diagonal triangle C, 2? My mind's open. 1, 2, 1, 2. Looks like a 3rd wave collapse in progress. But then, like the precious metals do a lot, it finds support again. 1, 2, or A of 2. Now it's starting to come back up. That sure doesn't look like a wave 3. It's got the appearance of a 3-step decline. So now right here, our probability that we're in wave 3 seemed pretty high, but now suddenly we're shifting to this A of 2 probability. Even though that B looks a little far, it's still a 3-step decline. It's beginning to come back up and overlapping. We can label this B of a 2 possibly. Let's look at some more information. Sure enough, it's coming right back up. This is a very complicated, irregular 2, but it happens. You can label this, that's A of 2, so we're going to label a 3-step B, A, B, C, B, C, B. Now these underlines are 1 degree smaller than these, which are 1 degree smaller than these. In other words, we're looking for a minor 1, 2, which subdivides into an irregular A, B, C, which in turn, the B will subdivide into an underline A, B, C, 1 smaller degree down, just like those notes you took. But look at this. How do you count that without violating any rules? 1, irregular 2, 3 is not the shortest, get out your PRCs. 4, no overlap. 5 of C of 2. Is that strange? Yes. But it doesn't violate any rules. Your stop is above there. Maybe you go home and you're writing it off. I'm going to get stopped out of platinum, I'm wrong. I mean, that's just too weird of a wave count, but that's what happens after that. Your stop was there. There's your payoff. It made you sweat for it, but your stop is placed based on the wave principle, and if it gets taken out, you're wrong. Get out. If it doesn't get taken out, you're going to make a lot of money. That's what happened after that. You can start to see it again. This is not an impulse wave rally. This is not an impulse, but that was 5 down, and it held. The 5 down told you that the trend had turned down no matter what it did after that. Unless that stop was taken out, the trend is down. Again, another 5-wave decline. That's labeled wave 3. This was left in this workbook taken from last year's workshop because it was labeled in real time, and it's a good example of a very complicated wave count and how the wave strategy can get you through some difficult times by not breaking any of the rules. Since then, picking it up from this wave 5 of 3, this is platinum updated through May. This was 5 of 3 in your workbook. You can see, again, a triangle appearing, which is one thing that you commonly find in wave 4 positions. Whoops. A, B, C, B. They're all 3s. C, D, E. 4. So then wave 5 drops 1, 2, 1, 2, 3, 4, 5, 1. This gets tricky again. 2, 3, 4, 5, 3. ABC 4. Now we got to start. Now we're continuing to get tricky. 2 things happen. One, this wave 5 of 3 hit a Fibonacci number, which is where, following the trading strategy that we're doing, you'd have orders enter the market to cover this short. But if you did in this wave 4 and the 1, 2, 3, 4, 5 failed to go to a new low, but nevertheless came down and held Fibonacci support, now you can count 5 waves down and you cover the shorts and you're expecting an ABC rally, and that's exactly what happened. In fact, this pulled another one of these, rallied all the way up to 630 after that. So the 5-wave decline, or whatever alternate count you're working off of, resulted in a rally, not violating any of the rules of the wave principle, kept you short for the decline and allowed you to cover. If you didn't have orders under there, you can count the final drop out of the triangle. You know the triangle means that it's preceding the final move in that sequence. As soon as it drops under that low, you want to be using this as an opportunity to cover your shorts that you initiated up there. Sometimes I'm going to miss a move, but I think there's always another streetcar. In other words, if I miss that foreign currency peak, If you're right, there's going to be 5 waves down and 3 waves up. You sell the 3 waves up, so you didn't call the top. That doesn't mean you can't make money in the Swiss franc. The Elliott wave system is one of the best methods I know to monitor your forecast and let you know when you're wrong, and that's the name of the game. But Bob Prechter will be up later on today, and we'll have a summary of what he feels is good for what it takes to be a trader. And I thank you very much for this morning.